listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy Byrne.
Hey, everybody. Welcome back to the Daily Gold Podcast. With me today on this episode is David Morgan, the editor and publisher of The Morgan Report, which you can find at themorganreport.com. And I love having Dave on because nobody has a better historical perspective on the precious metals markets than Dave. And Dave, I don't mean to date you, but it's really true. And for my first question for you, just give me a big picture view, how you're feeling about precious metals. I mean, what comes to your mind? What's going on? How are you feeling about the way these markets are trading right now, relative to the past couple of years?
Sure. Well, that should take about an hour to answer, Jordan. Thanks for having me on. It's great to be with you on this podcast. Well, my basic view, the big picture hasn't changed. All fiat fails. That's what, 3 words, all fiat fails, 3 words. So because of that fact, we have to look at, having some protection, some insurance. I don't like either one of those words, but a hedge. And that means, for the most part, precious metals. We've got thousands of years of monetary history that proves that fact. Now, once you establish that, what's the right amount? And I've said, publicly for years, 10% is probably enough for most people. 20% if you're super bullish. If you want to go above that, that's certainly your choice. You don't have to. And my thinking of the current last couple of years is we definitely bottomed the end of 2015. And we've been in a more or less pretty good uptrend for gold since. We finally broke through that 1350 level basis U.S. dollar last year, and we're working a new 1550 level as a base for gold. I think we're going to get about a 20% move in gold this year and probably a 30% move in silver. Silver's been lagging gold, but the way these metals have been in a somewhat of a bear market from 2011 up until last year, it's not surprising to be seeing silver as a laggard, and especially that the dynamics of silver are different than gold because it's a more aggressive investment. It moves up faster and higher than gold percentage-wise, and conversely moves lower and faster on the downside. Because of that, a lot of, I think, crypto fans have moved out of silver over the last few years and into the cryptocurrency market, never to come back to silver, and a few that do both. In other words, they've maybe moved out of silver, made a big score in a Bitcoin investment, for example, and maybe got out of Bitcoin at the $17,000 level and moved back into silver. Actually, I'm saying those numbers because I met a young guy at the Acapulco conference last February when I was there, and I gave that kind of scenario that if it were me looking at the chart, I think I'd be taking something off the table here, and silver's pretty low. And this young guy came up and said, hey, I did exactly what you were saying you would do. You say you sell your Bitcoin now and move into silver. And by the time that conference came around, Bitcoin was down several $1,000s, so he was pretty happy.
Okay, just a quick historical question for you. And I know there's not a perfect answer, but when you think about where precious metals are right now in this cycle, for a historical comparison, are we in 1930? Are we in the 1960s or 70s, mid 80s, or early 2000s, 2007? I know that there's no perfect answer, but if you were going to make a historical comparison, where are the most similarities as far as now versus the history of precious metals bull markets?
Well, the one I'm most familiar with is the one that I went through already because of my age. I'd say we're probably in the 1978 range, where gold and silver have gone up and down. Gold went from the 42.22 established price all the way up to 200. Then it got creamed by Mr. Simon from the Treasury and others in the nice government men and moved all the way down to about the 100 level. Then it moved from the 100 level all the way to 850. But we've seen, I think, the big up move in the gold to the 1900 level and then down to wherever it got. I forget the exact price. You may know, 1300s or something. And then we're back up now, working toward the 1900 level. So I think we've got another year and a half, 2 where we're going to continue higher on a moderate rate, and then we're going to hit the acceleration phase. So I want to say something about that. If we look at the second leg up, and so I'm forecasting this the third leg up if you're an Elliott wave person. So there's 5 waves from the big picture. You've got one up, one down, one up, one down, and the last one up. So third wave up, or the fifth wave, if you want to think of it in the ups and downs. In that second wave up, we saw gold and silver bottom during the 2008 financial crisis, and we saw silver actually get a 30% premium on it because there was a lack of retail product in the silver market. And that showed a quote-unquote shortage. It wasn't a silver shortage. You could buy it off the exchange for the paper price, but you couldn't get it in 100-ounce bars or coins or small bars or any investment situation at that level, at that price. That resolved itself rather shortly. But what I want to do is point out what the market did. So it went from a bottom of about $9 in silver, I'll round it to 10, up to 50. So that was a 5-bagger. You went from roughly a $10 level in silver all the way up to 50, and then it peaked out last trading day, April 2011, early May. And we've been kind of working lower and finally built a base, and we're moving up slightly in the silver market. Gold's done better, as I said earlier. But that move was a 5-bagger. Well, the third leg up is usually twice as good as the second leg up. So if we had a 5-bagger on the second leg up, Jordan, it suggests, no guarantee, that the next leg up would take it up by twice as good, which means a 10-bagger, which means your $13 silver times 10 is 130. Now, I'm not saying silver's getting into 130, although in the early 2000s, I said in this bull market, I saw silver achieving triple digits. I saw $100 silver in the future. And, time will tell if I'm right or wrong, ostracized or whatever. But I just want people to understand that the next phase is going to be what I call the run to gold, or the panic manic phase, or the breakdown of trusted government money. Or, there's a lot of labels I could put on it. But history's showing again and again and again that all fiat fails. When the perception of another 1% of the population globally says this fiat's failing, whether it be the yen or the euro or the dollar, and it'll all happen pretty much, in my view, simultaneously, or at least led by the dollar being less and less trusted, the run to gold, I think, will be phenomenal this time. And that will take silver up. And once silver starts up, it will kind of gain its own momentum, because then people start getting on the web and saying, oh, my God, silver used to be at 16 to 1, or there's less silver for investment purposes than there is gold, or, oh, the banks really suppressed silver from 1873 on, or all these type of things will start coming out probably, on the internet, in chat rooms, in social media, or wherever else. So all of a sudden there'll be this kind of new resurrection of silver bulls that don't exist now, that will all of a sudden understand the monetary story, the monetary history, and why silver is probably more important in some ways than gold is. So I really am looking for a huge move out, I don't know, a few years. I don't think it's going to be 10 years from now. It could be. I don't know. I think it's more like 3 years out. I think it's 2023, 2024, somewhere in that time frame. I don't think the system is so distorted now with these negative yields, with the bond markets being absolutely gambling casinos and nothing more, with stock markets elevated beyond all reasonability, and for fear in the marketplace due to currently this coronavirus or something other black swan. And that, may be the black swan I've talked about for years. I said there's so many out there, sooner or later something's going to take place and you will see a run to gold. So that's my long-winded answer. I really am bullish on the metals. And again, I want to put it in perspective. You don't have to be all in on the precious metals to do well. Most people just need a hedge position and forget about it. Buy that 10% and go to sleep at night. You want to be in the stock market, the bond market, the real estate market, whatever, be my guest.
I have one question about it, because I think you mentioned an acceleration phase. But before I get to that, just thinking about, how do you feel about like dollar cost averaging into the metals? If someone's not that sophisticated, they believe what you're saying. That's always something I've thought about, because dollar cost averaging in conventional markets, it's such a big deal. They talk about it for retirement. Why don't the unsophisticated or inexperienced investors, why don't they just buy a little bit of gold and silver every month? I mean, they can participate in the bull market, and if we get this vertical move that we're all expecting, it seems like they're going to be much better off, and all they have to do is just dollar cost average a little bit every month.
Well, as you may recall, or maybe not, I mean, I wrote about that in the 10 Rules of Silver Investing, which I encourage anyone listening to this podcast to just type in David Morgan, 10 Rules of Silver Investing, and I talk about it. Dollar cost averaging, I think, is a great way to approach a market, but it must be a bull market. And, of course, we had a great bull market from basically 2000 to 2011. Gold was up year over year every year for 11 straight years. So you can't really, complain about, gold being, not the place to be during that decade. And, of course, the last 6 have been rather trying, but we're still in a major bull market, in my view, and kind of technically showing that. So I like the idea of dollar cost averaging. It takes the emotion out, and it's a good way just to build a steady, base of sound money in your portfolio. I actually love it. I advocate it for most people. I think most people that, come into the equity market or even the bond market are always looking for what I call an amateur's attitude. They want to buy that exact bottom or get out the exact top, and no one does that. A professional accumulates. A big purchase by a money manager, fund manager, sovereign wealth, whatever, especially a smaller company, they must accumulate over time. They can't put in a buy order for, millions of shares in a company without moving a price, and they know that. So they have to buy it over time so as to not disturb the market too much. Same thing on the way out. They can't really put a huge sell order in, or it'll take the market down substantially, so they have to feed it out as the market can take it. In other words, they have to accumulate over time and distribute over time. And that's basically the essence of the stock market, or most markets. There's an accumulation, markup, and distribution phase. And right now we've been in the distribution phase for the general equity market for quite some time. But we're still getting the talking heads on the major financial channels telling you buy, 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 look, up, up, up. But as it's going up, the pros are distributing to the less sophisticated.
Okay, now back to the acceleration point. Do you think, I don't want to pin you down a specific timing, but when you were talking about that several minutes ago, it made me think about gold breaking above 1900. I have to think that when that happens, just tell us about if and when that happens, the significance of such a breakout and how that might factor into the acceleration that you're talking about.
Well, it's a lecture that I've given a few times, and I'm pretty sure I have it for my paid people. Normally when I do a lecture series during the year, and I usually have 2 or 3 different speeches as we progress through in a given year. But one of them is 90% of the move comes in the last 10% of the time. And that is a fact. So if you were a silver bull back in 1965 when the coinage changed from silver, 90% silver coins to the Johnson slug, and you said, this is wrong, I know monetary history, I'm going to start accumulating silver over time. So you started in 1965 and you went all the way to the beginning of 1979, you would have seen silver at $6. So from $1.29, the monetary value of an ounce of silver at the time, all the way up to $6, and you did get a real return in, what was that, 14 years? I don't know, something like that, more than 10 anyway. But then let's say you're just a rank speculator and you said, you know what, $6 silver is an all-time high. I think it's going even higher. And you bought silver at $6 in January 1979 and held it 1 year to January 20th, 1980. It was at $50. So you went up 800% in 1 year. And I did the math on it, and I forget the exact numbers, Jordan, but it was something like it made 87% of the move in 7% of the time. So 90% of them. So it's absolutely imperative that people understand how markets move. Now, am I saying the next move in the precious metals is going to be 90% and 10% of the time? And the answer is no. The answer, but the idea is very sound. If you look at how the stock market accelerated in 2000 when we had the NASDAQ go crazy cuckoo up to 5,000, you see what the real estate market did a couple of times in my lifetime. All markets get into this acceleration phase. And this is where everybody's brother-in-law's cat has to have an E-Trade account and buy a gold stock. I mean, I know I'm trying to be facetious, and I am, but I'm making the point that these acceleration phases are parabolic, and everyone gets excited, and no one wants to sell because no one knows how high is high, and you get a new high and a new high and a new high, and it builds and builds and builds. We already saw that take place in silver during phase two. We saw it go from $9 up to $50. Now, once it got like in the 25, 30 range, everybody was convinced, except yours truly, that we're going to 100. And I said, no, I think it's going to peak out here. And I called it 2 days before the exact top because I've been in these markets too long. And I know when everybody believes it can only go to a certain point, it's probably getting very, very near a top. And it was. I called it and hopefully saved a lot of people a lot of angst because of, taking some profits at the top. I was wrong as far as what the duration would be. I expected 2 years, 3 at the worst, and it actually has been like 6 or more. But, yeah, I just can't emphasize it enough. It's probably the best question you asked, in my opinion. What about the acceleration phase? The answer is you want to be on board during the acceleration phase. You want to be that person that knew nothing about silver, nothing about technical analysis, nothing, just was willing to buy that ultra high price $6 silver and hang in there for a year and sell when everybody wanted it and go from $6 to $50. That's what you want.
Okay, now moving from then to the very short term, talk to me about the, I'm looking here on the day we're speaking, gold's up to $15.90. It looks like it's going to make a daily high close, but silver and the gold stocks have not been confirming the strength in gold to start this year. How do you look at that? I mean, does that tell you anything that we might correct here or consolidate for a little while longer? Or, I mean, is it possible that silver and the gold stocks could really start to catch up? I'm surprised at gold that we've had this little divergence in gold is even after a sell-off a couple of days ago is now even higher.
Yeah, gold's acting very, very well. I'm really happy with it. I mean, silver's up 2.5% today, kind of making up for what it did 2 days ago. But it's really having a hard time getting much above 18, and it will. But no, the stocks is an important question. I mean, usually the stocks lead, which means if the underlying precious metals equities are moving higher and gold and silver are flat or slightly off, then that portends that the metals are going to start moving higher. When the metal stocks start showing weakness, usually it portends that the metals themselves are going to fall off. But there are different dynamics. I had a question from a paid member recently. I've got these 3 silver stocks. They're going down, and silver's been going up, and these 2 silver stocks went up. They work on a different dynamic. I mean, all stocks basically run off of earnings. The higher earnings that the stock makes, the higher the price of the stock should be. That's very generalized and extremely broad brush, but that's the essence of stock investing. So these are companies. They move on a different dynamic. If you want exposure to the silver price, buy silver or buy a silver ETF. Then you're going to get pretty much a 1-to-1 correspondence. The stocks I like because if you're selective, you can do better than the market. I mean, our portfolio of top tier was up 63% on average last year. And that's far higher. In fact, the best one out of the pack of 7 stocks is up 100%. And it was a silver stock. So if silver went from 15 to 30 last year, I don't think there'd be too many silver bulls that'd be unhappy right now. So it does show you get the leverage in the stocks, but you got to be a little careful. So I think there's not enough data yet. I know I've used this excuse before, Jordan, but I would like to see, the first couple of weeks of February before I made a determination. However, if I saw a huge sell-off in 2 of the major, gold stocks, I'd say, okay, folks, hold off purchases, build cash, put in a stop or whatever for, subscribers. But I don't see that yet. I think it's best just to hold here. But I don't like the action. I would love to see the underlying equities confirming this move. And you're correct. They are not short term.
Okay, I have a different question on silver stocks. I just want your observations on how there's just a dearth of silver stocks out there right now. I mean, it was a terrible bear market. A lot of the silver companies, the major ones, they diversified into gold, which was a good decision. It seems interesting to me that, in the coming years, we could be going into a major bull market, but there's a dearth. I mean, we're already in a major bull market, but it seems there's a dearth of silver companies. How does that compare? I mean, I should have a better memory about what happened 10, 11 years ago. I mean, I don't recall like a huge influx of silver companies. I mean, there were some, and there were a whole lot of new juniors that sprung up. But what about in the 70s? I mean, was there a tiny amount of silver companies, and then money really got concentrated in these names? I mean, how do you look at the history of that, and then think about today, where literally there's like a dearth of silver companies? Like, you could count the major ones on one hand, and it just seems like there's no more than even like 15 left of pure silver companies, even if you're looking at the juniors. How do you think about that?
Yeah, no, I think it's an excellent question. I mean, again, with my gray hair and what I've got left, I can give you, I think, a pretty good answer from experience. So during the third phase that we talked about, 90% of the move in the last 10% of the time, what will take place, I'm certain of it, it happened last time, it'll happen again, is the mineral de jour, which will be gold and silver. There'll be all kinds of small companies that right now are, let's say they are lithium companies. They'll change their name and be a silver company. There'll be a lot of that. And there'll also be a lot of new companies that are promotions only that will come to the fore that come out as penny stocks, and they're very cheap with great websites, probably great promoters, lots of super good advertising. And you'll just see a plethora of new silver companies and gold companies that are coming out of the microcap world, which are going to guarantee you, or almost guarantee you, instant riches. So when you see that kind of stuff thrown at the wall, we're getting pretty near the top of the market. Now, you can participate in that. In fact, David Smith and I wrote in our book, Second Chance: How to Profit from the Coming Tsunami in Gold and Silver, how to play those carefully, because you got to be very careful. And this is where a lot of people get hung up that are unsophisticated. They see these 12-cent stocks move to $1.20 in 3 weeks, and that kind of thing could and probably will happen at the acceleration phase, when the acceleration phase is very near the end. In other words, like when I started getting worried about silver going above 30 in 2011 and started cautioning people in the public, I said, look, if you got to buy, I mean, it just was a panic buy at that time, or close to it. And a lot of people wanted to buy the $30 silver when they never wanted to touch it when it was under 10. And I told people, if you have to have silver, don't buy it all right now. Be careful. Buy half and wait, or whatever. But, people get excited and they do what they do. So coming back, when you start seeing a whole bunch of new promises and new promotions going around, particularly silver, but gold as well, that's a time to put on that yellow flashing caution light and tell yourself, you know what? I'm going to start getting out of this market. It's time to give these people what they want. Let me sell into strength, and let me not get too greedy and not be an amateur looking for the exact top. Let me be happy with the gains I've made. And then again, in our book, we have what we call a sacrifice fly trade, or trades, that you can basically still stay in the market if you're trying to get that tippy top, because it is a little discouraging on these small caps to see them go from about 12 cents to $1.20, and God, I made 10 times on my money. I'm so happy. And then watch it go to 240 and wish you were still in. So there are ways to accomplish that with not a lot of risk. There is some risk. Obviously, it's impossible to eliminate all risk, but there are techniques that we provide in the book that you could participate, hoping for what we call a sacrifice fly, and catching that last part of the momentum before it exhausts and the market starts coming down again.
Okay, thank you for that. Dave, as we close, can you please give out your website, where people can follow your work and how they can subscribe?
Sure. just go to themortgagereport.com and give us a first name and an email address. We'll ask you to verify it, give you on our free newsletter. If you are interested in making money in these markets, then we suggest you get to the subscribe pull-down menu and watch the video and read the sales page and make a determination whether our reports are suitable for helping you enhance your resource sector investments. By the way, I wanted to mention copper real briefly. I look at all the resources. It's not just gold and silver. I mean, we were the first on rare earths. We've done lithium. We've done cobalt. We've done copper. We've done lithium. I mean, we've looked at everything. Right now, we're pretty focused on the precious metals because that's what the market is telling me to be focused upon, not my brain saying, well, I like lithium right now. It's just what the market is determining. But there's lots of ways to approach the market. I think our approach is kind of a balanced approach. Big money in big companies, mid money in small companies, and we love to speculate. And I've got one speculation in the electronic waste sector that's basically underfollowed and undervalued at this time.
Thank you so much for that, David. I love having you on. I mean, I could ask you questions all day, but got to stop it at some point. Thanks so much for coming on, and I look forward to having you back, hopefully in the months ahead, and we can chat about new developments in the precious metals markets.
Jordan, it's always a pleasure, and I know you're technically oriented as CMT, and a lot of my friends are, and so I love some of those questions because a lot of people that aren't technically oriented don't really know about the type of questions you asked. And I think, we covered some really good stuff on the acceleration phase of the market, what the speculative side looks like when you start seeing all these penny dreadfuls come out in force. And, there's lots of clues to look for to not get too greedy and take massive profits. And I think that are ahead of us and probably not too many years away.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to thedailygold.com. And for premium coverage of precious metals and the best junior mining companies, visit thedailygold.com/premium.